Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today as the market hit a new yearly low on stocks. Why IV matters, a comparative from Friday's close to the last time the S&P 500 was trading at a similar level, and how IV affects pricing. So let's jump in and take a look, shall we? First of all, here's the chart. We always like to look at the technical, fundamental, and implied volatility analysis. You can see S&P 500, the SPY ETF, closing at the lowest level of the past 6 months. So certainly getting hit pretty hard here as the Iran fears and kind of the AI fears as well starting to come home to roost. How much more it has, we shall see. Definitely getting oversold. 9-day RSI, MACD, Bollinger Percent B, all at the lowest levels we have seen in a long time. The last time they were here kind of marked significant short-term lows in the stock. We'll see if it happens again. Really not looking for a rip-roaring rally, but maybe for the selling to subside just a little bit. From a fundamental analysis, as we said, we like to look at, here's the simple PE ratio on the S&P 500. You can see now trading below 26x. Back at our comparative date, we're going to go back to September 5th when it was trading at virtually the same price. The S&P 500 ETF on the SPY trading just over 28. So certainly valuation multiple is softened somewhat, but interest rates, right, are now at recent highs. They have charged much higher here. Back on our comparative date, we're going to take a look at the 10-year yield trading just over 4%, now over 4.25. So higher rates sort of buffering that multiple, right? So we're seeing cheaper multiples. Certainly at some point, multiples will matter. Stocks will become fairly cheap, especially given the growth rates we shall see on them. We always like to look at implied volatility analysis as well. Probably most importantly, here you can see here's a 30-day implied volatility, now at the highest level since those Liberation Day lows when the tariffs first came into an effect. Last April. You can see the move from Thursday to Friday, a big jump in IV on the SPY. You can see it was trading right around the low kind of 20-ish area, now over 24, so a huge jump there on both the puts and calls. Taking a look at a 30-day chart on a 6-month basis. Here's the IV on a slightly out of the money 40 delta call. You can see trading at the highest IV over that time frame as well. You can see it jumped 17 vol points out in April, which is going to be where our new kind of comparative versus September 5th, the last time it was there, and do a side by side. So let's jump in and take a look. So I simply pulled off the last time the SPY was at a similar price, 649.12 on September 5th. Compare that to Friday's close, 648.57. So within shouting distance, only about 50 cents lower, right, on that. So on September 5th, you can see the October 670 call, which had 42 days to expiration, right, was trading at about 274 at just between 10.5 to 10.7 IV, right? So with the SPY at 649.12, that October 670 call out of the money by about 20 points, right? Trading at just under $3, right? With 42 days to go to expiration. Fast forward to Friday, I took a look now at the same 670 call, right? But in April with only 27 days to expiration. Back then 42, so basically 2 weeks shorter time frame. Normally shorter term options trade at a lower price, but because of the huge jump in IV, they're actually trading at a much higher price. Here you can see those 670 calls trading at about $7.20. Back there under $3. So they, in essence, they have more than doubled in price, even though they have less time to expiration now, right? And with the SPY at virtually the same price, it's actually further out of the money on the calls, right? Back then, the SPY was at 649.12, right? On Friday's close under 649 at 648.57. Yet the calls more than doubled in price. Why IV now at over 18, right? Where back then it was under 11. So certainly anyone who wants to take advantage of the high implied volatility regime, right, can sell some out of the money calls, sell them shorter term, get twice as much as you did before, get bigger downside protection, still have 20 plus points of upside on that. So certainly interesting how the call prices have shot up, even with the SPY a little bit lower now versus September 5th. Same thing on the put side due to put call parity. September 5th, again, we're looking at the 630 put, trading at about 556, again at 649.12. Fast forward to Friday's close, we can see the 628 put now, right, further out of the money. Yeah, the SPY dropped about 50 cents. We're going 2 points lower, so getting further away from the money, but that put that is further away from the money with only 27 days again to expiration versus 42 back then, right? Further out of the money, shorter time frame, you'd expect it to be much lower. Instead, it again is basically higher by about $3.50, right? Why? Because that huge jump in IV moving from, where it was before at under 16, right, to poking towards 30 on here, trading at 28. So the puts have also jumped in price appreciably. You can get further out of the money, shorter term time frame, get a bigger net credit, right, if you're somewhat bullish on the market. And combining the two, taking a look at the straddle, right, which is selling both the calls and the puts at the same time, going back to our September 5th benchmark date at 649.12. That 650 straddle, basically the at the money straddle rate, trading at just over $22, trading at roughly a mid 12 IV. Fast forward to Friday's close, we can see the 648 SPY, that April 650 straddle right now trading at over 33 points. So it's gone up 50%, even with the SPY really not moving, right? And even with now the SPY having 14 less days until expiration, 15 to be quite honest. So 2 weeks shorter time frame, right? SPY at the same price, you're able to get 1.5 times what you got before, simply because of that huge jump in IV. So selling a straddle, if you want to do something a little more neutral in nature, right, really capture that IV, right, you'd be selling a 56, selling a 45, so you'd be short 10 net deltas, right? And interesting to note to the back here, right, because IV charging higher makes, the calls, because of the upward bias, more pricey, right? Here you'd be virtually, net, zero deltas here, because the IV, or the delta, I should say, on the put went a little bit lower. The call a little bit higher, right, simply means, and that's with the SPY dropping and with less time to expiration, simply because of that jump in IV, you're able to get in at a more bearish position, slightly bearish again. 10 deltas net short is certainly not bearish, to say the least. So for those who want to take advantage, you can sell an out of the money call for much more than it was before, back September 5th with the SPY at a similar price. Out of the money put further out of the money for a bigger net credit, right? Give yourself more cushion and get more money on the trade, or combine the two and sell the straddle. For those who want to do it more in a defined risk manner, taking a look at the call spreads, right? Pulled off the 665, 670 call spread going back to our benchmark date on September 5th, SPY 649.12. That call spread trading at $1.45, right around an 11 IV. So you're out of the money by about 15 points, or a little over, 2.5%, right in that range, right? Fast forward to Friday's close, we can see that same call spread with the SPY a little bit lower, right? So the call spread should be a little bit cheaper. 2 less weeks expiration, call spreads definitely should be cheaper, but that call spread actually increased in price to well over $2. It was trading under $1.50 previously, September 5th. So you're getting, in essence, 50% more with a bigger cushion, right? Less time to expiration, all because IV shot up now, residing at just under 20 Back then, we were looking at IV just over 11. So certainly selling a defined risk call spread makes a lot of sense. And here you're risking 280 roughly to make 220. So your return on risk is very nice as long as the SPY remains well behaved over the next couple weeks. The put spread, same idea there. Our benchmark date back on September 5th, SPY at 649.12, right? IV roughly in the mid 14 level. That out of the money put spread, right? The 635, 630, trading just under 90 cents at 89 cents, right? Again, 42 days to expiration. Fast forward to Friday, right? Only 27 days to expiration, 2 weeks less, right? And we're looking at now a point further out of the money, right? The SPY was about, 50 cents or so lower. We're looking a point lower, so we're further out of the money, right, on the SPY, but we're able to get a bigger net credit of $1.28, right? And with only 27 days to go. So further out of the money with 2 less weeks to expiration, right? We're able to get, in essence, 40% more on the trade. So here you'd be risking roughly $4.10 to make 90. Now you're risking about $3.70 to make $1.30. So much better return on risk on that. So taking a look too, we can look at the iron condor combining the call spread and put spread. So I simply pulled off, right, the 685, 690 call spread, 615, 610, right? Both about 35 points out of the money. So back on September 5th again, with 42 days to go, SPY at 649.12. That iron condor trading at about 70 cents net credit, right? So you'd be risking, in essence, 430 bucks to make 70 bucks. Have plenty of cushion, right? You'd have, 35 points on either side. So you're looking at, about a 5% move over that time frame of 42 days. Fast forward to Friday's close, and we can see that same iron condor, we're now trading at $1.67. So it's more than doubled in price, right? Even though you have less time to expiration, right? And even though it's basically the same amount of out of the money on either side, you still have, about 35 points of cushion on either side, but you're able to get more than double the net credit. So here you'd be risking about 330 bucks to make 170, or about a 50% return on risk. Back here, right, you're risking, 430 to make 70, so a much lower return on risk there of somewhere around the 15% level. So certainly the iron condor is a way to take advantage of that, get a much bigger return, right, for basically the same trade with 2 weeks less to expiration. And then finally, if you want to get further out of the money and still get a little bit more money, right? I looked at going 10 points further out of the money. So instead of selling the 685, 690, and then the 615, 610 on the put side, it'd be 695, 700 call spread, 605, 600 put spread, right? 10 points bigger cushion, right? 2 less weeks until expiration. So further out of the money, shorter time frame, both by a large degree. 10 points further out, 2 less weeks to expiration, right? With the SPY at virtually the same price, you're able to get just under $1, whereas before, as we said, just 70 cents. So you're able to get a bigger net credit, right? Get less time to have it happen and get further out of the money, a bigger cushion. So hopefully provide some insight how we go about taking a look at trades here at Big Time Options to find that edge and put on the hedge. But as we always like to say, trading is all about probability, not certainty. So make sure you position size accordingly and make sure you get out when it's time to get out. So until next time, as always, here's the good trading.